Hello, everyone, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit highly appreciated assets tax deferred so you create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts, and each episode I'm joined by some of the best wealth, business, leadership, and real estate individuals in the world to share ideas, deal stories, and inspiration so together we can make complex tax deferral strategies simple and passive income plans achievable. I'm super excited about our next guest. He's been in the finance world for the last 20 years and has recently started a new firm teaching institutional philosophies to the personal financial world. And so I'm really excited to have a super good conversation with Kyrill Asatur. How are you, bud?
Hey, Pierce. Thanks for having me.
Yeah, absolutely. Okay, so let's start with your backstory. How'd you get to where you are today?
Sure, happy to. So I've been working on Wall Street for about 20 years. I started out right out of undergrad at Goldman Sachs. I was there for about 8 years, largely in the prime brokerage business, which is the business that handles most of their hedge fund clientele. In 2009, a hedge fund client of mine, founded by two ex-Goldman investors as well, hired me to come on board. I joined them, spent 5 years there, was recruited into a handful of other hedge fund roles post that, and about 6 years ago, struck out on my own and started a consulting and advisory practice. The idea for Centerfin, which is what I'm working on now, came to me about 2 years ago. We put a team together, and we went live at the beginning of this year. And really, the idea came to me because over the 2 decades that I've been working on Wall Street, I've had friends and family approach me time and time again, asking me, what to do with their, hard-earned savings, retirement accounts, taxable accounts, and whatnot. And I frankly just never had a good solution for them because spending all of my career interfacing with large institutional investors, I was very familiar with how kind of large, sophisticated investors manage money for the long term. And those options were just not available for individuals. And so we decided to build Centerfin to address that issue.
Awesome. Okay. So I want to take you a little bit back here, and I want to dive into this because I think this is a super interesting topic. But what are one or two gifts that you have or strengths that you have that have led you to be successful today?
That's a good question. I have not been asked that question in a while, but I would say from at a very high level, I think historically I've had a pretty good grasp of the bigger picture and a pretty good clarity around the bigger picture. And what I mean by that is just kind of trying to see the forest through the trees and not getting caught up in the minutia. That's, I don't know if that's just how I'm wired, but that's been something that's guided my career over the years and helped me make the moves that I made over time. And that's frankly the reason why I started Centerfin, because I see this opportunity. I think the time is right for what we're doing, and that's what guided me to do this.
So basically, your ability to cast vision and see the forest from the trees, not get caught up in the minutia and the details, but be able to lead through from a detached perspective and know what needs to be done and when to do it, and then be able to distill that down to explain it to people in a way that they understand. And I don't want to say dumb it down, but simplify it for them.
Yeah, that's another good point. The other thing that I think I've done a good job of over the years is not overcomplicate things. I was actually having breakfast with a hedge fund manager yesterday, and we were talking about this. Wall Street, as a machine, kind of preys on our human bias towards complexity, and so by making things feel and seem more complex than they are, they try to extract value. I've always been I've kind of flipped that on its head personally as my philosophy. I've always, attempted to, kind of distill things down to their kind of bare bones and help people understand them. That's a big part of it. And I would say also, as now an entrepreneur for the last couple of years, running my own business with a team, drilling down into the details is necessary when when the time comes. But keeping that kind of North Star, so to speak, and trying to make our way towards that as a team and as a business is really kind of what's probably the most important thing.
Awesome. Yeah, I think that's really wise, and the people who can do that, I think, are really successful. So that's awesome. So let's get into this. What help us? What do we do today?
Oh yeah.
What are the big dogs doing, man?
I don't know. I don't know. I've learned that there's sometimes a lag between when we record these things and when they air. So I just want to be careful about talking about markets in a very specific way. But needless to say, it's 2022 and the markets have been crazy.
It is 7/14/2022.
Okay.
Where they just announced that inflation's at 9.1%, and they're dumbing it down. So we're talking about that right now.
Correct. Yeah. So I think kind of one of the most important things I would say that we were observing, so to take a step back, generally speaking, when I say the institutional approach, I mean something more than a 60-40, 60% stocks, 40% bonds kind of cookie cutter portfolio, right? So unless you're ultra wealthy, you're generally going to get some version of 60-40 portfolio, whether you work with a traditional financial advisor or you work with a robo advisor, or if you're doing it yourself, you might be doing some other creative things, but about 2/3 of the people either work with a traditional financial advisor or a robo advisor today. Unfortunately, unless you're very wealthy, that's all that's available to you. And so the way that institutions differ is that they don't have those kind of constraints. So they allow both alternative assets and alternative investment strategies into their portfolios to help diversify from those two, broader assets, stocks and bonds. And so that's kind of that was the idea behind Centerfin, and that's what we've built, and that's what we're going to continue to innovate as we grow. But in this environment, I will give you a kind of a specific things that we did coming into 2022. We were observing, and we're talking to, on a regular basis, to very smart global macro hedge funds, credit hedge funds, equity hedge funds. This is my background, our CIO, our CFO. We all have decades of experience in the hedge fund industry, and we have great relationships there. And so we're informed by a lot of those conversations that we have. And going into 2022, one of the things that we kept on talking about was, well, is this inflation, which last year was in the kind of, mid-single digits, but had this narrative around being transitory, as we all know by now, whether that was more than transitory. And our view is that there was a pretty significant probability that it was more than transitory and it was going to become entrenched.
Let's pause this really quick.
Yeah.
I want to, you mentioned a couple of things I want to dive into. So when you say, is this transitory, what does that mean?
So, to take a step back, since the global financial crisis, which was 2007, 2008, the Federal Reserve, which is the U.S. central bank, which controls the interest rate, how the level of interest rates in the country, and global central banks around the world have kept interest rates fairly low, which is also referred to easy monetary environment, right? It's effectively, just to kind of simplify it or dumb it down, the price of money is cheap in that kind of environment, right? You borrow cheaply, mortgage rates are cheap, you can get financing on cars relatively cheaply. That was in response to the subprime housing crisis that we saw unfold in 2007 and 2008, because it almost collapsed the financial system.
Right.
Now, that since that period of time, that policy has worked because there's been no inflation. And so the Federal Reserve, at least, speaking to for the United States specifically, the Federal Reserve has two mandates. One is price stability, which is inflation. And for them, that means inflation has to be somewhere in the neighborhood of 2% a year, which means your money basically gets debased by 2% a year. And the second mandate is full employment, meaning that unemployment has to be low. And so, since the financial crisis, inflation has been very under control. It's actually been under 2% pretty much the whole time. And so every time we saw kind of a flare up of a slowdown in the economy, any kind of recessionary signals, the Fed would just kind of turn around and start easing, and that was okay because inflation was fairly low. Then we had COVID, which nobody anticipated, and we shut down the global economy, not just here, but everywhere on the world. Coordinatively shut down the global economy. And then we, meaning the Federal Reserve and the US government, basically printed money to help support businesses and individuals through that very difficult environment. Rightfully so. I mean, I don't think there's anything they could have done differently. However, the unintended consequence of and we just put this out in our quarterly letter, I think we printed about 9 between federal fiscal and monetary response in response to COVID over the course of 2020 and 2021. We printed $9 trillion. And that's, to give you some context, that's the US GDP annually is $20 trillion. So we basically added, 1/2 of US GDP, annual GDP, into the economy, just kind of stimulated the economy that way.
It's printed 40% of all dollars in circulation in the last
yeah, I mean it's pretty insane. It's a massive amount of stimulus. And what happened was that eventually that started to feed through markets, and it started to feed through into asset prices. And so you saw this reflected in everything from real estate to stocks to crypto to fine wine, fine art. All of these things, I'm sure you saw, started to become much more prevalent. People started talking about investing in these things, and really was a function of the same exact thing, which was all of this money that was flooded into the system, right? Now, what we saw starting in kind of early 2021 was now we were starting to see inflation in the cost of raw materials and the cost of energy prices, the cost of you saw these kind of spikes of like lumber prices spiked. You saw all sorts of raw materials costs spike early on, and the explanation from the experts at the Federal Reserve and the government was this is just transitory because supply chain issues, because we shut down the global economy, then we restarted it, and things will take some time to get back to normal, right? And so that was very long-winded way of answering what transitory meant, was that it was the explanation from the powers that be as to why we were seeing these like soaring costs in goods in early 2021 and throughout 2021. Sorry, go ahead.
So does transitory basically mean it's like their excuse for all these different excuses that they're making up, that basically, okay, supply chain, like we shut down the economy, like we have to get back and all this kind of stuff. And so, because of all these different like excuses together, that's why we're seeing prices, when in reality, it's because they just printed 40% of all the dollars in the last couple of years. And we're seeing that flood through the market price.
Yeah, that's exactly right. So it was them explaining what clearly, if it was not that, it would be a problem. And so it was kind of an easier way to explain away what was happening early on.
So how much of those excuses actually played a role or had a factor in this whole mess that we're in now?
Well, I mean, if you talk to most people, they would say both the federal government and the Federal Reserve. And when I say both, I mean the Federal Reserve is technically an independent government agency. And so they act, they have their dual mandate, and that's what they have to kind of focus on. And then the federal government obviously can pass, laws in order to, send stimulus to consumers via different means. And arguably, they did too much for too long, right? So that 9 trillion maybe shouldn't have been 9 trillion. Yeah. And because they were excusing away to some degree this early inflation problem that we were seeing, maybe is what got us out of control. What got us to where we are today.
Okay, and so now you guys are basically saying, well, duh, like the smart people saw this coming from a mile away and didn't buy any of that, fluff that they were throwing at us, and realized, holy crap, like you pump, half the GDP in 2 years into the economy. things are going to go bananas. And so you guys started strategizing against that, or how are you like handling that?
Yeah, that's exactly right. So we were kind of discussing this internally in the kind of second half of last year. And when we started to come, it kind of became, as time went on, it became clearer and clearer that it's very potential, it's very probable that inflation was not going to be transitory and it was going to become a little bit more entrenched. And in that case, the Federal Reserve, given they have a dual mandate, right, maximum employment, which has been very low for a decent amount of time now, and then price stability, which is inflation, well, the Federal Reserve would have no choice but to act to tame inflation. And the only thing the Federal Reserve can do that to do that is to raise interest rates, right? And so the most obvious thing to do if that were to happen, so we were going from, just to use the 10-year US government bond as a proxy, because that's the one that's mostly used. So that was trading last year at kind of between, 1.3 and 1.5%. And if they were to raise interest rates, significantly, that was going to go significantly higher. That would mean the market value of fixed income assets were going to have to come down, right? And so since most portfolios are structured, and we're not an exception, we have stocks, bonds, and other things, but since most portfolios have stocks and bonds in them, you were going to see the most obvious kind of thing to do was to cut your fixed income exposure. And that's what we did coming into 2022 as a way of kind of getting out of the way of that interest rate hike that we expected from the Federal Reserve. And we also rotated into things that we felt like would benefit from an inflationary environment that was more sticky than transitory, like commodities, right? Commodities is kind of an obvious place that benefits from inflation. And so that's what we did coming into 2022. And now in the first quarter, that looked great because we saw inflation, we saw the Federal Reserve raising interest rates, fixed income assets had kind of, I think one of their worst starts ever. But equities had some volatility as well, but we had, the commodities to offset some of that volatility in the equity side of client portfolios. Second quarter, and as I mentioned this, I was just writing our letter for the second quarter. The second quarter, everything was down as we introduced a new element into the kind of narrative and the conversation, which is recession, right? And so towards the end of the second quarter, the economic data started to come in relatively weak and show clear signs of slowing in the economy, and hence all of the very cyclical things like commodities rolled over also. So then you had stocks go down, bonds went down, commodities went down in the second quarter. So it's been kind of a brutal start to the year. The worst start for stocks in 50 years, worst start for I think most asset classes in a very long period of time.
So let me ask you this. I mean, they pumped, the problem seems to be that they pumped all of this money into the economy, right? And now that flow of money is slowing, right? Because that money, that velocity of turnover and money is slowing down. And so but where did it all go? Right?
So
did it just go to Jeff? And that's that? At Amazon or what?
No. I mean, it did go. It flows ultimately into asset prices, right? And that's why, as I was saying before, you saw, the price of real estate, the price of stocks, the price of crypto, the price of real assets, obviously housing and commodities, everything went up. And what happens is, it goes into kind of the stuff that is most obvious first, and then it starts to seep into the stuff that's more speculative. So that's why you saw, crypto and biotechnology and high growth technology. Those are the things that had the craziest, price performance, right? But what happens, to your point, when that reverses, which is what started, at the beginning of this year, that stuff comes down the hardest as well.
Right.
And we actually started to see signs of that in early 2021. If you look at very speculative high growth technology stocks and biotechnology stocks, they actually peaked in February 2021. So they've been in a downtrend for, going on 18 months at this point. So crypto obviously evaporated $2 trillion of value since.
Of course. So, but does the money go into these assets and then burn up? or because it's not like, is it because they literally didn't really do anything? They just added some zeros on a screen and sent it out to a bunch of institutions who basically just added some more zeros on a screen. And that was the thing. And then when they loan money, they're loaning just, I don't know. I don't want to say monopoly money, but like basically money that doesn't actually exist. And so like when it goes into an asset, it just like evaporates, or like where does it go from that asset?
No, so it does go into the real economy, right? So like the stimulus checks that happened in early 2020 when people were forced out of their jobs or were forced to work from home but couldn't make a living, that gave them income to be able to support their lifestyle and get, go spend on regular goods and services. So it does flow through to the regular economy. And then above that, it starts to flow through into these asset prices. So just to use a simple example, real estate, right? So interest rates were at, the 30-year mortgage fixed rate was below 3% at, throughout 2021. That's very low, right? What do people do when you can borrow at below 3% for 30 years and put a small down payment on a house and your monthly payment is low? People bought houses, right? Because
why not?
That's their incentive to do so.
Free money.
So yeah, and because there's a structural in housing, and specifically there's a structural issue with supply and demand. There's not enough supply for the demand, just generally, because they haven't built enough housing to provide for the demand. Prices went up significantly, right? So it literally is just no different than there's more demand than the supply, and prices go up.
Right.
And then when it reverses, just goes the other way.
So, I mean, when in this like correction that I think everyone, I mean, are we kind of following the Michael Burry, it's going to be the worst crash of all times because of all the, derivatives that are just kind of like out there, are we all doom and gloom, and this is going to be either depending on how you look at it, the best buying opportunity of our generation, or is it going to be, as bad as 2008, or where do you think where do you fall on that spectrum?
Yeah, no, that's a great question. And Michael Burry is a great example of somebody who I think has done a really remarkable job of seeing some of these very big picture things and capitalizing on them. I think our kind of internal thought process is such that the Federal Reserve. So there's a lot of people that think basically it all comes down to what the Federal Reserve does at the end of the day, believe it or not. Like, because if they continue to hike interest rates and tighten fiscal and monetary conditions, the price of money goes up. That's going to bring everything more down, right? And it's going to slow the economy into a recession. That's going to bring everything down even more. So there's a whole school of thought since we started to see these recessionary signals in the economic data in the second quarter, in the second half of the second quarter, that already started to price in cuts. So like that they're going to hike and then they're going to immediately cut. So they're going to hike and ease, because recession is coming. So if you were to believe that school of thought, then we're probably somewhere in between what you described as, a huge buying opportunity and a complete disaster, right? So there might be some more volatility to the downside, and then, it should give us a good kind of grounding to build a new base to buy for the long term. You have to remember, we're managing money on a 10, 20, 30-year time horizon, so we have to keep all of this stuff in context as we make decisions. There's another school of thought, which is that the Federal Reserve kind of has their hands tied. They have a dual mandate, which is maximum employment and price stability. And maximum employment still exists. We just had the unemployment number on Friday. We're at 3.6%, which is kind of near, I think, all-time lows. But inflation is at 9.1%, like you said, reported just yesterday. And so, if you believe that the Fed will continue to hike, things in markets, things probably get worse before they change course. And so I think we lean towards that latter camp a little bit more. And so, we've been a little bit more cautious in how we've rotated the portfolio around, because it just feels like the Fed does not have enough of an excuse not to continue to hike. And that's what we're seeing already since this 9.1 number came out yesterday.
Yeah. So this next rate hike that's about to happen, if they pop this thing up a point or whatever, like, what is that going to do? I mean, even more, because isn't the whole philosophy you hike rates and it lowers inflation, right? Like, and if we're still continuing to rise in inflation and they're hiking rates, like, might be a bad recipe for the economy.
Yeah, no, it's not great. I mean, they're not in a good spot. The point hike was not even, it was a very low probability event before yesterday's number. It's now, I saw something this morning that it might be at 83% probability, right? And all of the Fed, they always walk out, all these Federal Reserve presidents of all the different districts, after these big economic figures come out to just, to help guide the market, right? And you're seeing just over the last couple of days, they're already talking. Some people are saying no, 75. Some people are saying 100. It's possible, depending on what we see. The PPI number this morning was not good, which is another measure of inflation. So they might have their hands tied and they might have to continue to hike. The not so bad thing about that is that it kind of helps rationalize just prices, right? Like, so some of the stuff that we saw, as I mentioned, in the very speculative part of the asset markets, high tech growth stocks, some of them are down 70-80%, SPACs, biotech stocks, crypto, all that stuff has come down. It's a factor of the Fed pulling back this liquidity and hiking interest rates. And it's actually not an unhealthy thing in the long term. And so it just might be painful in the short term.
Yeah, and that makes a lot of sense, right? Like, it needs to consolidate and cool off, because it was, we were going at such an unsustainable pace that it was ridiculous. Like, if it kept going, no one would be able to do anything. We would have gone into this crazy hyper inflationary situation. It would have been like Venezuela, carrying around a wheelbarrow,
Yeah, no, it's definitely not, it was not a good trend. You're absolutely right. And so this is not, even though it's short-term painful, it's not unhealthy.
Yeah. Okay. So short-term painful. And so, are we basically just getting rope-a-doped right now, and you just got to Muhammad Ali it and put the gloves up and just take the punches as they come and until you weather this storm and move on? Or what are people who are about to retire doing? Because they're the ones who are getting after.
I got to tell you, you raise a great point. We talk about this internally. Our client base is largely kind of 30s and 40s, so they're decades away from retirement. And so, like I said, we take a much longer time horizon view, and it's a nice luxury to be able to do so. My parents, who are kind of on retirement age, are in a tough spot because their stock portfolio, which look, it's been managed professionally and it's doing relatively well. It's kind of doing what it's supposed to be doing. But it's down, right? And their house, which they plan to sell as part of their kind of retirement planning, is going to be down in value, right? So it's tough for people that are planning on kind of imminently retiring or were planning on imminently retiring, because we might be in these doldrums for some period of time. You were asking, is this like a 2008 or there's none of these periods are the same, but there's there's elements of that rhyme across all these periods. And so I lived through the 2001 internet bubble, right? There's elements of that in this particular period. There's also elements of what happened in the 1970s, because that was the last time we actually had inflation that was a problem. And so you kind of have to piece it all together and figure out the best way forward. But it's not easy. I mean, you'll hear some of the smartest investors in the world tell you it's the most challenging environment to manage money professionally in their careers.
Yeah, and it'll really kind of the cream will rise to the top here, and everyone's a genius, right? When you can't fail, and so that makes a lot of sense. And so, what if you are down, right? Are you basically saying like, you know, hey, sell something on Spotify or something, like don't retire right now? Or like, what do those people do who are in that situation that, the asset prices have dropped and I mean, cause what, like stocks fell, are we at like what, like 50% right now or something crazy like that?
No, it's not that bad. I mean, there certain individual stocks are down north of that, but those would be the same stocks that were up, hundreds of percent going into this. Overall stocks are down. The S&P 500 is down, a little over 20% year to
Okay.
date. The Nasdaq's down 30% year to date. Crypto, if you consider that, an investable asset class, which we all, I think everybody, most people have exposure these days.
Yeah.
That's down even worse than that. But I think, look, I mean, I think that for us, we don't have that client base, so it's actually a luxury not
Yeah,
to
definitely.
have to kind of worry about that problem. But you know, I would be in favor if I were to advise my parents, let's say, and this is not investment advice, but I would be in favor of of just being, a little bit more active around what's going on with your, liquid asset portfolio. So your stocks and bonds and just being, that's why, like, that's actually why it makes sense that what we started, because I think a lot of people in kind of these bull markets just think it's easy to do it on your own, and why do you need to pay somebody to do it? But it's important to actually have professional advice, to kind of to help manage through periods just like this.
Yeah, no, absolutely. And I think that's going to kind of lead me to this point here that I want to make. So, people who are, and we live in Orange County, in California, and asset prices have skyrocketed, especially real estate. Stocks might not be as up, but I mean, still, even if you invested in Bitcoin at a couple $1,000, like, you're still significantly up, right? So we had such a huge like bull run, and prices are consolidating. I think they will eventually go back up here in the next probably a couple of years or something like that. We might be down for a little bit. We might see spikes here and there, but that leads me to this point. So a lot of people who have real estate and super high high capital gains assets, right, are selling them. And I think one of the most dangerous things they can do is, if they have a really high tax, this is Capital Gains Tax Solutions podcast. So I mean, if they have a high tax, right, like, how do you capitalize on that without feeling the impact of that tax? I mean, that's almost 37% here in California. If you sell a piece of real estate that has a gain of anything over $500,000 and you're married, so how are you guys advising on that situation?
So we don't actually provide tax advice, and actually right now we're largely managing retirement assets. So we also have the luxury of not worrying about tax implications of trading and being in and out of stocks, which is something that we've done. But yeah, I mean, I agree. It's a problem.
Yeah. So I'll kind of answer that question. So one of the things that we do here at Capital Gains Tax Solutions is we use a vehicle called a Deferred Sales Trust, which, unlike a 1031 exchange, which is you sell a piece of real estate and you go back into real estate, at more debt, and in the markets that are appreciating, right, you're selling high and you're buying higher 6 months later. You only have 6 months to buy something new, and so that's a really like condensed time frame. And what happens is people get motivated to buy because they don't want to pay their tax, right? We had a gentleman out here who bought this property for 500 grand on the beach back in the 90s, and it's worth almost $8 million now. That's like $3 million in tax that he's got to pay if he sells that thing. So it's trying to explain that. And then like, where do you go? Right. But what the deferred sales trust allows you to do is allows you to capitalize on that, sell the asset. It can be any asset. It could be a stock or crypto or a primary home or commercial real estate or whatever, art. You can sell any asset that's highly appreciated and then defer the tax, but then you're able to use that tax and use all of those proceeds to reinvest. And it doesn't have to be the same like kind. So you can sell. So we had a gentleman who sold his business. He deferred, I don't know, 600,000 in tax. He sold it for like 2.2 million or something like that. And he put it into a pretty, standard ETF mutual fund type of, investment where he was earning his 7%, 8%, right? And then he found a real estate deal a couple years later where he's like, all right, I'm going to go into that. It's a development deal in Tennessee, but it gave him the timing to go in there and do it. Plus the extra $600,000, right? That he was earning 8% on that he didn't have to pay to the government. Now he gets to use that to go into a new deal. So it increases the amount of liquidity that you get. If you're going to leverage it, it increases the amount you can leverage. You're earning interest on that as we're going. And so it's a phenomenal tool, and it allows for people like yourself, Kyrill, who have clients who have these, big taxable events, right? To also capitalize because, if they're going to, if this guy, right, sells his property for $8 million, right? Let's say he's your client. You got an extra $3 million that you get to put at AUM, that you get like on top of that, which bodes well for you, right? Bodes well for him. And so it's just it's a phenomenal win-win solution all the way around. So if you guys are curious about that, you can go to capitalgainstaxsolutions.com and learn more about that. And we have a mastermind group every Friday at 10 a.m. Pacific, 1 p.m. Eastern. Kyrill, I'll send you an invite as well, because I think you would be super interested in learning about that, especially as your clients start to mature, because I think that down in the next couple of years, there will be some good buying opportunities. And a few years down the road, it might be a really phenomenal solution for you to bring to them if you guys get to that point in your
I look forward to learning about it. Yeah, absolutely. Sounds very interesting.
So anyways, there's that. So Kyrill, where can people find you?
So the website is centerfin.co. I'm, Kyrill, Kyrill at centerfin.co, and very available to anybody that wants to chat and even just chat about the markets. And then I'm on Twitter at Wall Street, WALLST Hobbs, HOBBES.
Okay. So Wall Street Hobbs or centerfin.co.
Correct.
Awesome. So guys, reach out to Kyrill if you're interested in learning more about that at all, and checking out what he's got going on over there with his things. All right, we're coming up on our time here, so I want to bring you into the lightning round really quick.
Sure.
So what's your favorite book?
So, it's funny, I don't know if this is like an all-time favorite, but I was just reminded of this recently at my wedding, which is a while ago. We had a small wedding, and I gave all of the groomsmen a book called How to Be a Gentleman. Yeah. And I was just reminded by somebody else talking about some of the, basic concepts that I think sometimes get lost in society, but I think are important to maintain.
Awesome. Yeah. How to Be a Gentleman. What's your favorite leadership quote?
Leadership quote. Well, I'll tell you the quote that really got me thinking about starting Centerfin is a quote from Tim O'Reilly, which he originally pitched it to Google to be their slogan when their slogan was "Don't be evil," and his suggestion was create more value than you capture. And I thought it was just a very cool concept that I think if a lot of people followed, would just be kind of better for everybody. So that's one of the things that we talk about is just trying to create more value than we extract.
Yeah, that's awesome. And what are you most curious about right now?
Most curious about, I mean, I got to tell you, in these markets, it's like spending night and day trying to, read the tea leaves and follow what's going on. And I just think I think it's really important, at least for us as professional money managers to be aware of what's going on, because I think it's going to be kind of going to be a wild ride for maybe the next, couple of years.
Yeah, it's going to be interesting. That's for sure.
Yeah.
Buckle up, everybody, because we're going on a roller coaster. Hopefully you like Six Flags.
Yeah. Yeah, exactly.
So you might get your neck jerked, but anyways, awesome. All right. So guys, centerfin.co, you can get in touch with Kyrill there, and also on Twitter. What was your Twitter handle one more time?
It's Wall Street Hobbs.
Wall Street Hobbs. Okay. And if you guys are interested in learning more about the Deferred Sales Trust, or you have a highly appreciated asset that you are thinking about liquidating and trying to get on the sidelines and want to kind of protect your downside during this market, you can reach out to us at capitalgainstaxsolutions.com. Come join our mastermind every Friday, 10 a.m. Pacific, 1 p.m. Eastern. You can find the registration link on the website, capitalgainstaxsolutions.com, and check out our YouTube videos, rate, review, subscribe. Any parting words, Kyrill?
No, I really enjoyed the conversation. I look forward to learning about what you guys do, and thank you for having me on and being generous with your time.
Yeah, no, thank you for coming on, and I really appreciate it. And thanks again, everyone, for listening to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven strategy such as the Deferred Sales Trust and using professionals like Kyrill and centerfin.co is the best way to create passive income and create, preserve, and grow your wealth, guys. Thanks again for listening. Please rate, review, subscribe, comment, share, like. Am I missing anything?
Get them all.
Come hit our websites, and we'll see you guys on the next one. Thanks again, Kyrill. It was a pleasure talking to you. We'll talk to you on the next one.
Thanks, Pierce.